Hello everyone, welcome back to the second part of the video lecture where we are talking about the GDP and various concepts associated with that. We have so far covered the definition of GDP. We have looked at the so-called value-added approach, and then we have looked at how to calculate GDP by using the so-called expenditure approach, where we figure out how much expenditure has been made by various players in the economy, the household, the firm, the government, and the rest of the world. We add those and we get the GDP. The next method of calculating GDP is called the income approach, and we want to understand how the GDP is calculated in this methodology. By principle, the income approach is to find the costs and the income, that also includes the profit, that are generated in an economy to every player in the economy. We generate the sum of the costs and the income, because some people's cost is another people's income. So basically we find out what is the income of everyone in the economy and then add those up, and we get a GDP. The underlying assumption is that the income of the economy is basically spent on economic activities of the economy. So when you generate an income, that is generated either as a result of production of a new good or a service. That could be selling an old good, by the way, or providing some kind of consultancy service, some kind of an intangible services. But any of those services will be able to generate some kind of income. So the income approach of calculating GDP is pretty intuitive. As it turned out, the income approach of calculating GDP is much more rigorous than the expenditure approach, because the income approach will require a lot of information from you. Now, based on how much information you have, your GDP calculation could be different, and we are going to look at basically two ways of calculating GDP in the income approach. But before we do that, there are some information that we need to calculate income approach in either ways. So let's go over some of them. The first concept is called the national income. National income, by its definition, is straightforward. It is the total income earned by the factors of production owned by a country's citizens. The problem with national income is that it only looks at the citizen of a country, regardless of whether they live in. So you could be an American citizen living in Germany, setting up an ice cream store, and the income that you earn is somehow part of the national income. But you can understand that based on the definition of GDP, that income earned by an American citizen living outside USA cannot be part of the GDP calculation. So we need to find a way to adjust or extract GDP information from that national income. Now, national income comes from a variety of information sources. The first and the most important of them is called the compensation of employees. Compensation of employees, as the name suggests, are compensation of the workers, right? So that probably includes wages, salaries, and various supplements. This is like employer contribution to social insurance, pension funds, and these are interesting in the sense that these were not traditionally or formally introduced in the expenditure approach. But we know that if I have a pension account from which I receive income and I don't have a job, that actually becomes my income. So we need to really keep track of these employee compensation and the employer compensation. Compensation of employees are most of the incomes that you and I have. The next one is called the proprietor's income, which is, proprietor is a fancy word for self-employed person. So if you are self-employed, meaning that you are unincorporated, the income that you earn is part of proprietor's income. Then rental income is the income received by property owners in the form of rent, Corporate profit is the profit or income of the corporations. Remember that this is kind of different from revenue. Revenue is not the income of the corporations because they have to pay part of that as cost. Net interest is interest paid by businesses. So this is like you are a firm that borrowed money from someone, either a bank or someone else, and the net interest rate that is being paid is the interest that you pay, and that is part of the income as well to someone who has lent you the money. Indirect taxes minus subsidies, these are probably income of the government, because government does collect income tax, and these are government's income. But then the government has to pay subsidies, so that's government kind of expenditure. So net income minus taxes are basically income of the government, right? Net business transfer payments, this is transfer payment made by business to others, like an employee compensation or contribution to social security funds and things like that. This could be just grants or loans, financial aid, transfer payments that if you compensate your worker for a workplace injury, this is where it's going to be. This is sort of the income of the household, because most of the times household is at the end of the receiving end. Surplus of government enterprise, a very interesting idea. It's not that important for a country like USA, but for many countries, government owns enterprises. Like government provides telephone services, government provides utility services, and the income that these organizations generate are part of the government income as well. Okay, with those information in mind, let us now look at the two approaches of calculating GDP. The first approach is basically quite simple. So you take a look at all the wages, the compensation of employees. You can identify the interest rate, rents, and profits. You add them together. If you add these two components together, you get your net domestic product. If you get your net domestic product, then after looking at the net domestic product, you should be able to use that to really calculate. And then so your net domestic product is thus just summation of the first two component. With that, you add indirect taxes less subsidies, so that's like your income of the government. Then you add depreciation, something that is very important to economics. Depreciation is the wear and tear of the machines that you're using. Now, anytime you provide a maintenance for your machines, that's where the depreciation cost comes in, and you have to understand that when you fix your machine, you generate an income for a worker, right? A mechanic. So when you add indirect taxes and depreciation, you get the GDP in the so-called income approach. Now, sometimes you are going to get some information about the statistical discrepancy. Statistical discrepancy is a way for the government to make up for some of the measurement problem that we have in the GDP calculation, because GDP is not well calculated. There are a lot of mistakes in GDP calculation, and we sometimes assign a statistical discrepancy, which is a number, by the way, a monetary number that has to be added or subtracted to get the GDP in the expenditure approach. So in the method number 1, you can calculate GDP by using the income approach. You can also calculate GDP by the expenditure approach. The distinction between GDP in these two approach is the statistical discrepancy. So please be aware of that. Now, before talking about the next approach of calculating GDP, I want to introduce to you another concept that was very popular till the 1970s as a good measurement of economic activity. It used to be called, and it is still called, gross national product. Gross national product is the value of goods and services that are being produced at a given period of time by the citizens of the country. So the way GNP and GDP really varies is the location of where the factors of production are located. Formally, GDP and GNP are related as follows. In order to find GNP, you take the GDP number, and with that you add net factor from abroad, where net factor from abroad is income paid to foreign citizens living inside the country. I apologize, I think there is a mistake here. This will be a negative sign, and this will be a positive sign. Okay. So when you look at that, you realize that net factor abroad is income paid to the foreign citizens living abroad plus income citizens earn from abroad. Well, that's actually that. So the next factor from abroad is this. So we have everything in the right fashion, I believe, and then so that's that, net return income from abroad. So notice what you are doing. If you substitute net income from abroad, you are basically adding the income of the citizens with GDP and subtracting the income paid to the foreign citizens living inside the country, and that gives you an idea about how much output is being produced by citizens of the country regardless of where they live. That takes us to the second method of calculating GDP. The second method of calculating GDP is a little bit complicated, and you can look at this table and figure out how these are calculated, but you can go in either way. I always start from the top, from the bottom, where imagine that you have the national income number, which is $13,833 billion. You first add a statistical discrepancy with that will give you a net national product, measurement of net national product. Notice that I am following strategy which are opposite to how this is calculated. So I add depreciation to that net national product, and I get a GNP, and from that GNP I add payments of factors of income. I add payments of factor income to the rest of the world, and I subtract receipts of factor income from the rest of the world, right? So receipts of factors of income from the rest of the world is American citizen living in Germany, and payments of factor of income to the rest of the world is a Mexican citizen working in USA. So you add the payments of the Mexican citizen living in USA, and you subtract the income of the American citizen making in Germany. When you add the income of the foreign citizens living in USA and subtract the income generated by a citizen in a foreign country, you go from GNP to GDP. So GNP and GDP are very close concepts. Okay, so if we want to summarize the two measures of calculating GDP, the expenditure approach and the income approach, this particular slide does a very convenient job. Please take a look at that at your leisure. We are now going to move beyond this discussion and take a look at first an example of how you can use the income approach to calculate GDP. We are going to look at two examples. First of all, if you are provided with the information that is in the table, you are asked to calculate GDP. Okay, so please take a look at the table and the information that is provided. Okay, as a rule of thumb for your exam and for discussions, how you calculate GDP is basically a function of what information is provided. If you look at the information, you should see clearly that with this information you cannot calculate GDP by using the expenditure approach. So you need to figure out how to calculate this by using income approach. So income approach, most of the information is provided. Notice that you have compensation of employees, you have proprietor's income, you have corporate profit, you have net interest, you have rental income, you have indirect taxes and direct taxes and subsidies. And notice that direct taxes really are not part of the GDP calculation. It's the net tax, which is indirect taxes minus subsidies, that is part of the GDP. So other than direct taxes, which is there to really confuse you, everything else on the on 1, 2, 3, 4, 5, 6 are part of the GDP calculation. So we calculate national income by adding compensation of employees, and then proprietors income, and then rental income, then corporate profit, then we have net interest, then we add indirect taxes minus subsidy, then we have add business transfer payments, which is basically zero in this case, plus surplus of the government, which is also zero in this case, and we get 635, which is the value of the national income. Now after that, we need to really start thinking about seriously about calculating GDP. The way we calculate GDP is that we first need to calculate net national product, which is national income plus statistical discrepancy. So we got that number. Then following the table that we looked at before, we calculate GNP, which is NNP plus depreciation. So you add the depreciation with your NNP number. Finally, when you have that, your GDP is nothing but GNP plus the payments of factors of production to the rest of the world minus receipts of factors of production from the rest of the world. You add those numbers, you subtract some numbers, and you get the number which is GDP. So that's a very important concept. So take a moment when you prepare for the upcoming exam, please take a moment to see how you can calculate that. So that sort of summarizes our discussion about how to calculate GDP by using various approach. What we're going to do now is start taking a critical view about what this GDP number really tells us. So far, the GDP calculation that we have carried out gives us a number which is called a nominal GDP, which gives us which shows us the market value of goods and services that are produced at a given period of time at the current market price. Now, sometimes, this number could be misleading, right? So we want to understand what GDP is calculated for to begin with. From our perspective, GDP basically tells us a lot about how our economy is doing. So sometimes what we do, we calculate GDP numbers and compare them across time to get an idea about how the economy is doing. Now let's say you have 2 years of GDP numbers, and the GDP number in year 2 has gone up compared to GDP number in year 1. But at the same time, the prices of all the goods and services have gone up from year 1 to year 2. So year 2 has more production, year 2 has more prices. Does that mean that the economy has really been producing more? Because part of the larger number in GDP is being reflected by the increase in price. So what we do in order to solve that problem, in addition to calculating nominal GDP, we also calculate a second concept called real GDP. Real GDP is very important because most of our macroeconomic comparisons is going to be available based on the real GDP number. So what is GDP, real GDP? Real GDP is the value of the final goods and services produced within a given period of time in a given year. Notice that the definition looks identical, except the fact that that is expressed in the price of a base year, which means that rather than taking different years' price to calculate your GDP, you design a year whose prices you are going to use as fixed prices, and you're going to use those prices to calculate GDP for all the years that you are comparing. So by setting up that base year, you calculate a new different GDP number that is called a real GDP. In a minute, we are going to see that one of the biggest usage of real GDP is that real GDP can help us to calculate something called GDP deflator, which is a very popular macroeconomic measurement of price. Before we see how real GDP is calculated, let us spend a moment looking at this real GDP deflator number and see what this number is telling us. Notice that in this formula, let's ignore the 100 for the time being. This is just to express this in terms of percentages. GDP deflator is nominal GDP divided by real GDP. If you think about these two numbers, you will notice that these two numbers have something in common. They are both measuring the same production, but the price in nominal GDP is the price in the current year, and the price in the real GDP is the price in the base year. So This ratio basically tells you by how much the price of the economy in the current year has gone up or gone down compared to the price in the base year. So the GDP deflator, in a very general situation, basically is the measurement of price for our macroeconomy, which makes it a very important concept. Before we look at how we can use the GDP deflator to get a measurement of price, let us look at two examples where we are going to learn about how to calculate nominal GDP and real GDP. The example that we are looking at is a very artificial example. You have information about an economy where there are two goods, hot dogs and hamburgers, and you have information about their price and quantity in 3 consecutive years, 2013, 2014, and 2015. Now, if you want to calculate nominal GDP for each of these years, all you have to do is just find the price of the good and the corresponding quantity of that good, multiply them and add them together. So you can see that this is clearly done in the first part where we are looking at calculation of nominal GDP. So calculation nominal GDP, by the way, we are assuming that this economy has only 2 goods. So we take the price of hot dogs, multiply that with the quantity of hot dogs, that is the total market value of the hot dogs, and then you take the price of hamburgers, multiply that with the quantity of hamburgers, and that gives you the total market value of hamburgers. You add them together and you get your nominal GDP. You do the same thing for 2014, you get the same thing for 2015. So that's a very straightforward way of calculating nominal GDP. Let's now look at situation where we want to calculate real GDP. Real GDP requires that you fix a certain year price as base year and you calculate GDP based on that prices. We usually use the earliest year as base year. So we have 3 years of data, 2013, 14 and 15. We are naturally going to consider 2013 as our base year. So in order to calculate real GDP, I'm going to take the the quantity of hot dogs in year 2013, but I'm going to use year 2013 price. For hamburgers, I'm going to take the 2013 price quantity and take 2013 price as the hamburger price, multiply them, add them together, and I will find the real GDP of 2013, which looks identical to the nominal GDP of 2013. So the only time real GDP and nominal GDP will be identical numbers is for the base year. Please remember that. For 2013, however, I will take the 2013 hot dog quantity, which is 150, but instead of using the 2014 price, I'm going to use the 2013 price as the price for hot dog. I will do the same thing for the hamburger, but I will take I'm going to take the 2014 quantity, but I'm going to take 2013 price. I'm going to multiply them, I'm going to add them together, and that will give me the real GDP of 2014, where the base year is 2013. I repeat the same thing for 2015. Once I have the nominal GDP and the real GDP for all the years, I can use the last part of this table to calculate GDP deflator. For 2013, GDP deflator is nominal GDP 200 divided by real GDP 200 times 100. So GDP deflator for the base year is 100. Please remember that, because that's always the truth. For 2014, I take the nominal GDP of 2014, which is 600. I just calculated that, so remember this is there. And I take the real GDP of 2013, which is 350. I take the ratio, and that gives me the real GDP deflator for 2014. I repeat the same thing for 2015, and I get the information that I need to get an idea about what the market price looks like in this economy and from a macro perspective. So that's basically an example of how to calculate nominal GDP and real GDP. We have another example available here. I'm going to skip this example because it looks identical to the one that we just did. Please do this on your own and kind of convince yourself that the answer makes sense. You can also calculate the GDP deflator, which is also explained in the slides. So we have just shown you how to calculate GDP, real GDP, and how to use the real GDP and the nominal GDP to come up with a second measure, with a very important measurement of price called GDP deflator. Now the most important use of GDP deflator is that we use GDP deflator to get a measurement for something called inflation rate. What inflation rate does is that it gives you an idea about what is happening to the overall price level of our economy. In a future chapter, we are going to talk about consumer price index as another very popular measurement of price level in our economy. But for the time being, this is a good one, right? So the way we calculate inflation rate, which is a very popular measurement of price, is that let's say we have GDP of 2 years, year 1 and year 2, and I want to think about how much prices have gone up in year 2 compared to year 1. So I take GDP deflator of year 2, from that I subtract GDP deflator of year 1, and I divide this expression by GDP deflator of year 1, and I multiply that by 100. So overall, I can use the calculations to really come up with. I can use the methodology to really calculate inflation rate, and that's very useful. There are other use of GDP deflator. What we can do in the GDP deflator is that we can use the GDP deflator measurement, and we can convert real GDP. We can calculate real GDP from nominal GDP. So let's look at this formula in a minute. So you have a formula which says that you can convert real GDP, nominal GDP into real GDP by as follows. So let's say you want to know what the real GDP of year 2 is. You only have information about nominal GDP of year 2. You also have information about the GDP deflators in these 2 years. So you take the ratio of the GDP deflator year 1 and year 2, and with that you multiply the nominal GDP of year 2, and that will give you the real GDP of year 2. So that's actually quite a useful way of calculating real GDP. Sometimes real GDP is important to calculate. Okay, so that covers the concept that we want to look at. We just came up with a measurement called real GDP. That gives us a more precise and accurate estimation of how the economic activities are changing. Now we are going to have a lengthy discussion about how good or how bad the GDP measurement is, right? So let us go back to the original idea that GDP is a concept that gives us an idea about how the economic activities are taking place. So it gives you an idea about economic activity, but our GDP suffers from a series of problems, which I initially highlighted in the first lecture, but now let's come back to this again. So there are major shortcomings of the GDP. First of all, GDP does not count any non-market production. What does that mean? It means that if you make a pizza at home, it is not going to include that in your GDP calculation. GDP does not include underground economy, meaning that if you sell drugs, which should not be part of GDP, but if you sell a burger on the street and you don't have a license, your burger is not part of the GDP calculation. The more unintuitive limitations of the GDP is that GDP does not have any adjustment or calculation for leisure. In order to understand this criticism, we need to really go back and try to understand why we are calculating GDP. From a philosophical perspective, we are calculating GDP because we want to know how the economy is doing, which means that we want to get an idea about how people living inside the economy is doing. And part of the well-being of the population or the citizen of a country really depends on how good their living standard is. So, to put it in a simple terms, GDP gives us an idea about the standard of living that people are maintaining in an economy. And if that is the objective, then our GDP not having any measurement for our leisure really does not capture our standard of living. Leisure is a very important good, right? There is an opportunity cost of leisure, which really does not get reflected in the market prices. So that's a major problem. Another problem of GDP is that GDP only takes the market value of the goods, but really does not care about the quality of the goods. Now imagine that you're calculating GDP for 1965 and GDP for 2015. In both of these GDP calculations, there are a lot of cars, right? Like the Ford Mustang and all those cars that were available in that time. And there has been major qualitative changes in the automobile industry. So a car whose value probably was a little bit lower in 1965 is not the same car as 2015, right? So we might say that we are calculating the value of the goods and services in 1965 and 2015, but we are ignoring the qualitative differences of the goods that are in these two numbers. So if we blindly just compare 2015 GDP with 1965 GDP number, obviously the 2015 GDP number will be a much larger number. That really doesn't tell us that whether our living standard has gone up, by the way. Right? Think about this. Okay, so one could argue that by ignoring the, sort of like the qualitative aspect, our GDP really underestimates the output increase, right? Also, it doesn't include any kind of harmful side effects, like it really does not take into consideration of, effects of pollution, things like that. They are also part of the, economic activities. So we have to be really careful about that. We can look at the limitations of the GDP in a slightly different approach. We can say that the limitations of the GDP is that it doesn't really include social welfare. So social welfare means, that it could be a distributional problem, right? So your GDP could be a very large number, meaning that the economy has a lot of income, but if those income is concentrated on the hands of a few, that is really not a good measurement of living standard, right? Think about it. Also, when you are not including domestic and non-market activities like housework, childcare, they are real production, but they are not part of the GDP calculation. And most importantly, these kind of non-market activities play a very important role in enhancing our welfare. So by ignoring them, our GDP also ignores important aspects of our welfare. Okay, political freedom, right? Freedom is a very important concept. Freedom is not included in the GDP calculation. It cannot be included in the GDP calculation. The health condition, the longevity, these partially gets reflected in the GDP calculation, but not perfectly. So one could make a strong argument that GDP ignores many of the important aspects of our living standard, and that's just it. But again, at the end of the day, one could make even more stronger argument that despite all these limitations of our GDP is still the most popular measurement of economic activities. So we really need to spend time understanding about how to calculate them. Okay, there is another usage of real GDP. In addition to calculating GDP deflator or giving you a better idea about our living standard. Sometimes we use a real GDP number to figure out how the capacity of the economy is changing over time, or we use real GDP number to better understand about the fluctuations of the economy, because our economy is not a stationary thing. There are a lot of things that happen every now and then. So what I'm gonna do now, I'm gonna spend a little bit of time talking about business cycles and potential GDP and real GDP. So we have already covered what real GDP is. Now I'm going to define what potential GDP is. Potential GDP is the value of the real GDP when all the economy's factors of production, labor, capital, land, entrepreneurial ability are fully employed, which means that your potential GDP tells you the maximum output that your economy can produce. Obviously, potential GDP is not the GDP that you always calculate. Why? Because almost always, as we'll learn later, that there are some resources of the economy which are underemployed or unemployed. Then it would mean, if that happens, real GDP will be less than potential GDP. Sometimes, in very rare cases, the resources of the economy are overly employed, and then your real GDP could exceed potential GDP, which, by the way, has happened. The best way to understand the relationship between real GDP and potential GDP is by looking at something called business cycle, which really talks about how the real GDP number fluctuates within a short period of time. When we look at the actual real GDP number in USA and in other countries, we see real GDP fluctuating. Sometimes it is going down, sometimes it is going up. These fluctuations are called a business cycle. Now, what is important is to understand that these fluctuations in real GDP are basically happening around the potential GDP. So what is the potential GDP? From a graphical perspective, if the red line is your real GDP, the potential GDP is the trend in that data. So it's the black line. So and there are some fluctuations of real GDP around the potential GDP. Notice that there are cases where real GDP has gone down compared to the potential GDP. So this is, and that's when probably you have, some kind of recessionary effects. But then there are unusual cases where real GDP growth rate is higher than, is above the potential GDP. So this is the example. This is an example where we can say that the economy is overutilizing its resources. That's very unusual and rare, but it happens sometimes. Okay, so when we think about real GDP, starting from 2008, we see a major departure from potential GDP and real GDP. We know that starting from 2008 and probably till now, the US economy is going through what we call a recession. So what is a recession? A recession is half part of a business cycle. A business cycle usually refers to a combination of an expansion and a contraction of economic activity. So expansion is when GDP is above the potential GDP, and trough, and a recession is when the GDP is less than the. So this is this is the contraction. This is the contraction, right? So you have two part of this activities. You have an expansion where GDP is going up. You have contraction where GDP is going down. Between that, there is something called peak where the GDP reaches maximum, and there is a trough where the GDP is. So that's the trough where the GDP reaches minimum. So you have expansion, you have peak, you have trough, and you have again an expansion. Sorry, I apologize. You have an expansion, you have a peak, you have a contraction, and then you have a trough, and then that is followed by another expansion. So this is like a game. The GDP goes up, reaches maximum, then starts going down, which we call recession, or sometimes called contraction, and then it reaches a minimum and then starts going up. So we can use the real GDP number to really keep track of these macroeconomic fluctuations in an economy. So our real GDP, or GDP in general, is a very, very interesting concept because it covers a lot of information that we use in our modern macroeconomics. And I hope that this lecture really gives you a brief idea about how to utilize these concepts and how to calculate these concepts. Thank you very much. Have a nice day.